I'm Cynthia Rowland, and this is episode 121 of EO Radio Show. Today I'm joined by David Sacarelos, a principal at Baker Tilly. We do a deep dive into the penalties under the Internal Revenue Code sections that apply to insider transactions involving private foundations. Using a recently issued IRS Chief Counsel memorandum, we look at the circumstances of loans by a private foundation that led to significant penalties for indirect self-dealing and jeopardizing investments. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. My guest today on this heavy topic of self-dealing penalties imposed on managers of private foundations is David Sacarelos. David is a certified public accountant with nearly 40 years of experience providing advisory and tax services to ultra-high net worth individuals and families, partnerships, not-for-profit organizations, and privately held businesses. His clients include multi-generational families, corporate executives, founders, and investors. He has expertise in income tax, estate, and financial planning, and consulting for complex financial transactions. All aspects of high net worth income, estate, and gift tax planning and compliance, tax accounting and reporting in support of fiduciary tax return preparation for complex trusts, consultation with families and individuals on philanthropic goals and their charitable gift planning, private foundations, public charities, and other not-for-profit organizations, complex investments underlying nonprofit and foundation funds and endowments, representation of clients before the taxing authorities, and foreign tax matters for individuals and families. Wow, David, that's a lot of stuff. How fun. Well, welcome to the show, David.
Okay, it's great to be here. Thank you, Cynthia.
Well, I'm so appreciative that you're willing to be here to share your wealth of knowledge using this particular publication from the IRS as our frame of reference. Before we dive into this particular Chief Counsel memo, it was just published. It's number 2025-04014. That's the technical citation. Let's give the listeners some background and orientation for these heavy topics. That is private benefit, indirect self-dealing, correction, and jeopardizing investments. Those are some intense tax code provisions that have a lot of framework around them. But let's just cover some of the background. What are we worried about in this CCA?
Well, in this CCA, specifically about private foundations, although federal law prohibits all tax-exempt organizations, including private foundations, from private inurement and unwarranted private benefit. And, as back in 1969, when a lot of the exempt organization legislation came through, they really did distinguish between what we would apply with respect to private inurement to a public charity than how we apply it to a private foundation. And I think that's really worked out really quite well in this ruling. And there's a couple things that really come out very well in this ruling. That first of all, there can't be a private benefit. And Cynthia, we often call that the operational test, at least I do, that the organization needs to be organized and operated exclusively for tax-exempt purposes. And if there is an individual or some other entity or someone else benefiting from the transactions inside the private foundation, unless it's just a small amount, it's probably going to fail that test. So that's the first test that the ruling addresses. We'll get into the facts a little bit later. But then they also address this concept of self-dealing. In that legislation I mentioned, and over the years, there's been more guidance. Self-dealing is really directed at certain financial transactions with disqualified persons. And when I look at a tax return or I look at financial statements every year, I look for any financial transaction between the organization and others and try to make heads or tails of whether or not this is a disqualified person. And then this ruling brings up something that we don't hear a lot of, is that there's something called an indirect act of self-dealing. And I thought that was interesting because sometimes we don't know if something is a direct or indirect. There is guidance in the regulations, but this one is frankly kind of obvious in my mind. And then the other thing that was brought up is that, especially toward the end of these transactions, these go over 13 years, but the question is whether or not these loans, which we'll talk about, are jeopardizing investments. And that is, the foundation manager needs to exercise ordinary business care and prudence when they're investing the portfolio or they're investing the endowment. Many of us call that the prudent investment standard. We, I think, refer to that readily here in California, but I think that's a term of art used all around the country. And that is, you're looking at the endowment, making sure that the long and short-term financial needs are met, and that there's probably some sort of diversification in the investment of the endowment. And in this situation, we'll talk about in a moment, clearly there was an act of jeopardizing investments. And just going to say, keep in mind that question is still on the tax return. Was there any act of jeopardizing investments during the year?
Right. All these things are supposed to be disclosed each year in the 990 PF. That's a great overview. We're talking about private inurement, self-dealing in particular, jeopardizing investments. And basically, those are the three meaty issues that we're going to talk about. So talk a little bit about what a CCA is. For us tax geeks, I myself included, we know what all these different forms of authority is. This particular one is not a case from a court. It's a somewhat unusual publication, a Chief Counsel memorandum. Can you talk a little bit about what these are and how they fit into the guidance that tax practitioners use when advising their clients?
This is a Chief Counsel advice, and this is a legal advisory to the IRS. It's sort of like the General Counsel is giving the IRS some guidance. And it's sort of like if you were in a company and your General Counsel gave you guidance. This is the IRS in that situation. It was with respect, it appears, to an audit that the IRS was underway with. These CCAs, or Chief Counsel Advice memorandums, I call them, they're legal interpretations. They usually explain things quite well. They are to be relied on by the IRS personnel. They're not what we would call, Cynthia, primary authority. They're not code regs. They're unpublished generally. We have them, I believe, because of the Freedom of Information Act. In any event, we like reading them because they have to be relied on by the IRS personnel. And because of that, there's no reason why we can't learn from them, in a sense.
Right. And I'll just comment that sometimes we see these advice memos as practitioners, and we may not agree with the Chief Counsel's interpretation or the way they've looked at certain facts. This particular one, I don't think has anything controversial in it. I think for most practitioners that read it, they're like, well, yeah, no kidding. But it is a really interesting, from my perspective, both in terms of the fact pattern and the very good, very thorough analysis that we see in the memo. Let's talk a little bit about the specific facts. And spoiler alert for all of the listeners, the outcome was not good for the foundation managers, the original donors. Probably everybody listening knows that. Otherwise, it wouldn't be a very interesting conversation. But anyway, David, tell us a little bit about the facts. It was complicated, and the actual CCA redacts a lot of the private information. But let's walk the listeners through an overview of what the founder did and how they got into this mess, and then we can dive into the technical analysis.
Well, sure. This was a private, non-operating foundation, and it issued unsecured loans to business entities that were founded, partially owned, and may I add, not necessarily controlled, but partially owned and operated by the foundation manager. The transactions occurred over 13 years, and there was two companies involved. Eventually, one of the companies went away, and company two is still there. Ultimately, company two becomes a disregarded entity between foundation manager and his wife, and it becomes basically an asset owned by them individually. These loans were never fully paid off, and in many years, the interest on the loans were not paid. It was very convoluted because toward the end, I think in year 13, they decided to restructure the notes and to reduce the interest with no consideration, no security. And I think at that point in time, the IRS said that is a jeopardizing investment. But you'd almost have to write on a piece of paper all the different loans that happen to the different entities over time. In a sense, Cynthia, it doesn't really matter what the loan balance was on any given point in time, is that these loans were really not appropriate under both the private benefit and also under the self-dealing rules. The ruling was very clear that, first of all, that these are indirect acts of self-dealing, that clearly that there is some kind of private benefit going on between the organization and the foundation managers because they are the sole benefactor on both sides of the transaction, and ultimately that they are jeopardizing investments.
We'll come back to the jeopardizing investment piece, but thinking about the private benefit, I mean, it seems to me that kind of in a nutshell, the founders took a charitable contribution deduction for the cash they put into the foundation, and then they used that cash as a piggy bank for the private business over a very long period of time. Maybe people are like, well, it's obvious if you do that when you lend the money to yourself, that would be bad. But why is it so bad if you lend it to a business that you're involved in? Well, that's where the indirect portion of the self-dealing rules comes in. It doesn't have to be a loan just to the founder in order to fall into this mess. Lending the money to a business that you have a private interest in is just as bad. And in fact, it actually ended up worse. So walk through a little bit of the analysis of the chief counsel on the private annulment piece and what happened to the foundation as a consequence of these transactions.
Well, with respect to the private annulment piece, ultimately, the ruling says they're going to lose their exempt status. I mean, that was clearly from the very beginning, that really the manager was personally benefiting financially, and that the organization really was not primarily operated with exempt purposes in mind. Keep in mind, which is even more telling here, Cynthia, is that almost all of the financial assets, almost all of the endowment was in these loans. There wasn't much left on the balance sheet. I will say also that the ruling distinguished between self-dealing in the normal sense, because you can make loans to an organization you don't have more than 35% ownership in. And in many of the years, in fact, most of the years, the foundation manager did not have more than 35%. However, the regulations talk about facts and circumstances, and it's clear the only one really benefiting from these transactions was the foundation manager. It was clear that this was an act of self-dealing. I think it is good when you read this, you ask yourself, well, what are legitimate transactions we can do here? If 99% of, only 1% of the endowment was used in a loan, and to an entity you own maybe 5% of, maybe we wouldn't be here today, in a sense.
I noticed in the analysis that there was a comment that the foundation did make charitable grants. And so it seems like maybe somebody was paying attention to the minimum distribution requirement. It's unclear how they were making those grants, whether it was from a modest amount of interest paid on the loans or whether it was new charitable contributions. Because some donors, if you don't have a liquid asset, you put in each year additional contributions that are enough to actually meet the 5% minimum. So it wasn't clear what they were doing in that regard, but because this ruling didn't touch on minimum distribution either, I'm guessing they were attentive to that rule, which is kind of funny in the grand scheme of things. They might have been paying attention to required minimum distributions, but not self-dealing, private annulment, or jeopardizing investments. But anyway, the fact the IRS said, or Chief Counsel said, the fact that you were making your grant distributions isn't enough to overcome the private annulment that was happening here, because in IRS Chief Counsel's view, or Treasury, whichever department, Chief Counsel's view, the scale of the private annulment defeated the charitable status altogether.
Yeah, that's right. I think what's interesting about that comment, that is kind of looking through the facts a little bit, is that they did make the charitable contributions or charitable grants. You're right. It looks like they followed the rules. But the question I would have is, how did they value the only assets they had were these loans? It's not clear to me how they were valued. Were they discounted? Or because that maybe is one of those special kind of properties that have special rules about valuation. We'd have to go back and look at that. But when almost your entire endowment is loans to an organization that the foundation manager has an interest in, how do you value that?
Yeah, right. Many questions in that regard. The bottom line in the private annulment and tax exempt status question that they start off the ruling with is they lose their exempt status. I don't know if it said retroactively, I don't know if that meant that that the foundation managers, donors, really, from that perspective, lost their ability to take the charitable contribution deduction. If you reach that stage, the IRS is pretty unhappy with the way the organization's been handled.
It doesn't say, it just says the revocation is appropriate. I was kind of wondering the same. Did they go back and disallow it from the very beginning? I don't know.
How far back? From there, the self-dealing rules, then we kind of shift gears because the loss of exempt status, that the consequences of all of that are on the foundation itself. So whatever income it has, it's taxable. But now we flip the conversation to the self-dealing penalties and who that falls on. So talk a little bit about who pays, or maybe this is a good point to dive into the penalties. Who pays the penalties for self-dealing and how do those generally get calculated?
There are exceptions, but they're generally assessed. These are excise taxes under the code, and they're assessed and paid by the disqualified person and the foundation manager, as the case may be. Keep in mind, this excise tax is a sanction for essentially wrongful doing. That you're basically not following public policy, you're not following the rules of the regulations with respect to private foundations. And I liked what you said earlier, that was this is piggy bank, because private foundations are really intended to be, in a sense, owned by everyone in the community, but they're not really supposed to be private piggy banks. There's 3 levels of this, Cynthia. There's the initial tax, and then we have an additional tax if you don't fix the problem. And then if you have to close up the entity, there's a termination tax, which is, some people call that a 3rd level tax. It really, in some respects, is kind of on its own. And the initial tax is generally 10% of the amount involved for the disqualified persons, and I believe it's 5% for the foundation manager. The additional tax, that is, if you don't fix it within a certain time frame, then the self-dealer is assessed 200% of the amount that was not corrected, and potentially an additional 50% for the foundation manager. Cynthia, there's a maximum of $20,000, or maybe that's been adjusted with inflation, but it's something like that.
For the foundation manager, yeah. Right, but not for the self-dealer. So let me see if I can, I always get in trouble when I do this, but if I do some simple math, let's suppose one loan in 1 year was $100,000, and the self-dealing penalty is on the amount loaned, right? So it's going to be 10% of $100,000.
And the unpaid accrued interest.
And the interest. Okay, so and for a loan, you have a new act every year. So let's suppose there was $100,000 loaned in year 1, and it continued for 13 years. Each of those years, the amount involved that the tax is imposed on is $100,000. Let's say it's just the 10%, so that's $10,000 every year. That adds up pretty fast.
It adds up, yeah.
It adds up really fast, plus the accrued interest that's not paid.
And I suppose it's worth mentioning that the ruling also talks about correcting it. They had this idea that we'll just give the notes to charity, although they're not paid off, and that would somehow correct it. I mean, that doesn't correct it. I think the idea behind that is you try to get the organization back to where it was before the transactions happened, as much as you possibly can do that. In this situation, the ruling just does say briefly that the loans should really just be paid back entirely to the foundation with interest. It doesn't quite go into all that, but I think that's what they're getting at. It just to remind us all that transaction is not necessarily fully reported on the Form 990-PF. We have to file a 4720. And Cynthia, I've had my share of 4720s over the years. I am a CPA. I'm not an attorney. I almost always have my clients show the completed 4720 to their counsel before it's filed, because I just think it's important.
It is. And the 4720 is the way to come clean. And sometimes these transactions happen inadvertently. We've all seen that where it was just either bad advice or they misunderstood or, let's give these guys some credit. Maybe they thought they were protected by the fact that the borrowers were all less than 35% owned and nobody examined the indirect nature. So the 4720, sometimes it's just money. You can fix it with that. It also occurs to me here that the correction would be repayment in my example of the principal amount. The $100,000 had to be repaid. So, and our disqualified person is in any event out the penalties. They've got to pay the $10,000 every year for the loan period. And then they have to give back the entire principal amount, not the company. The borrower doesn't have to pay this. the disqualified person pays the $100,000 back. There's no charitable contribution deduction for that, but it's in the foundation, which has now lost its tax-exempt status. If this were a California organization, there's layers of California regulations as well. You'd probably have to wind up and dissolve that foundation with the proceeds going to an unrelated, I'll call it a true charity, a real charity. So the donors, it's kind of adding insult to injury because it's a lot of money that has to go back out of the pocket of the foundation manager to the foundation. The penalties go to the IRS. And then what happens if they don't correct it? And I think that was part of, they were trying to do this other correction that doesn't work at all. But what's the next layer of penalty?
Well, then there's that additional tax, which is the 200%, 50% rule that I mentioned.
Yeah.
I believe also keeps stacking, if my understanding.
Yeah, I think so.
They keep stacking, and it's not entirely clear. In this case, the self-dealer and the foundation manager are the same person, too. Mm-hmm. So it's not clear how all that works out. Yeah,
I don't remember whether it's double, whether you get taxed as the manager and the disqualified person. The 4720 is an interesting form because it really does walk you through each year. If you're in for a penny, you're in for a pound in filing that 4720.
Let me just say also on the 4720, because I know that there's a number of practitioners that I talk with from time to time who ask me, do we really need to fill it out? It was just a mistake and we fixed it. And in many cases, as you know, Cynthia, private foundations share the same space as the family office. And we've had situations where the family office paid one of the bills and not the other bills, and we have to correct it. And my view is just correct it and pay it's really a small amount of tax and be done with it. I've never, ever had one of those bounce back. I think the transparency is important, but I think practitioners get scared. They go, well, we'll just ignore it.
There's sometimes if something's like discovered very early in the following year that some inappropriate thing was billed, nobody's going to lose sleep over it if an accounting entry is made to say this was just a clerical error by someone who was not a problem. Those I can get comfortable with. Obviously, something like this fact pattern, there's no ignoring the 4720. And the other advantage to filing the 4720 is that sometimes the penalties aren't that bad. There are reasonable cause exceptions that sometimes can be explained, and it starts the statute of limitations running. That's the other thing. And this kind of will lead us into the termination tax. Sometimes if you're winding up an entity anyway, or, you need to have an exit strategy for the organization, sometimes by filing the 4720 and coming clean on everything, that allows terminating the private foundation without having to pay what you referred to as the third tier tax, because you can't wind up a private foundation and get out of the crosshairs of the IRS until you file that final statement as a private foundation that you've wound up and there's no termination tax imposed. So maybe I stole some of your thunder there, but talk a little bit about how, using our example foundation here, if our founder, I guess it's interesting here because if their exempt status was revoked, they don't have to file the termination of private foundation. Yeah. But talk a little bit about what that penalty is, because the termination tax can be hefty as well.
Yeah, and in practice, we don't see too much of this because most of our foundations follow the rules of the road and they end up closing down and giving it to public charities. We see this ever so often when somehow foundation closes and not all of the assets get sent to an exempt organization. And again, it's pretty rare. But in this case, the exempt status was revoked for federal purposes. I'm assuming it would be revoked for California purposes. So the application of the termination tax, I'm not sure. They're going to probably assess something, is my guess.
Yeah, because the big idea in that termination tax is that the original donor gets a big tax write-off, and it's huge. And I think this one did say they contributed shares of stock. If you contribute appreciated assets and take a charitable contribution deduction, well, this was a private foundation, so there wouldn't have been a lot of capital gain.
Presumably, it was publicly traded stock into a private foundation, and they would have gotten fair market value deduction. Those facts aren't laid out in the ruling. Most of us know that if you give non-publicly traded stock, you're probably subject to the basis for your deduction.
So it could have been limited. But if we, running our worst case scenario of all the bad things that happened here, let's say it was low basis publicly traded stock. So their tax savings on the contribution was the tax on the gain, plus they took a full fair market value charitable contribution deduction. And so the termination tax would be based on those tax benefits to the original donor. I don't know if they can go back 13 years, though. going back to, should I file a 4720 or not? At least if you file the 4720, you've got a statute of limitations running. Maybe not for private foundation termination tax, but for a lot of these things. I guess it's also a really good example of the traps for the unwary in private foundation land. These rules are really technical. What would seem like it's fair, maybe they thought by charging market rate interest, it was fine. If you're thinking of the foundation as another business enterprise that the founders own, because a lot of people do feel very proprietary over their foundations. It's like, it's my money, it's my company. Yeah, I know it's a charity and I have to give money away, but it's just like my other businesses. And so a lot of people, I think, honestly feel like that's fine, that there's no problem. It's a thicket of difficult rules where experienced advisors are absolutely critical if you're having any insider transactions.
So Cynthia, I had a question for you. There's a couple of references in the ruling about, it just says there was no independent board member. There was no minutes. There was no corporate minutes. All these years, there was no meetings. Well, if there were meetings, they weren't documented. Would any of that corporate governance make any difference to the situation?
Well, I don't think having independent directors would have enabled blessing the transactions like you could do. If we were talking about public charities, the discussion is quite different because there's fair and reasonable can come into play. I think not having any meeting minutes, not having independent directors, not having anybody making a prudent decision on this only hurt them. If they did have meetings, if they did have independent advice, if they did do valuations, they'd have a better case for a reasonable cause abatement to the penalties. But without any of that, it's back to my earlier comment. This seems like it was just treated like a piggy bank. It was not treated like charity money. And kind of to wrap it all up, private foundations, they're private in the sense that they're classified under different rules. They're not private in the sense that, unlike public charities, it's the founder's money. It's money held in charitable trust. And if the fiduciaries, that is the board members, aren't acting like fiduciaries over somebody else's money, then that's going to that's going to lead to problems. And the structure of all these private foundation rules that came in the 1969 Act was to impress upon the fiduciaries of these private foundations that it's not their money. And so if you're managing it without board meetings, without a sense that you are managing charitable assets, it's only going to hurt you. I think that's the way I would sum that up. Back to the point of, would they have been better off if they had an independent director? Yes and no. Yes, in the sense that an independent person is more likely to question things and say, well, wait a minute. Are you sure that's okay? And so that's a huge value. In this particular scenario, I wouldn't want to be that independent director because if I'm in a position where I'm really pressured with peer pressure to go along with the founder, I'm just another deep pocket because I'm subject to that foundation manager tax, right? This independent director is on the hook, particularly if someone were named as a director and yet there were no meeting minutes and there was no record of that person objecting to these insider transactions.
It seems to me like an independent director might have said, hey, let's run this by our attorney. Mm-hmm. And that would have maybe stopped it. Maybe. Mm-hmm. I don't know.
Or something could have been modified to make it less problematic. Thank you so much for your time today, David. I know we've covered a ton of materials. I think we'll link the CCA itself. We'll put a link in the show notes. And if you have any other materials on this, David, that you recommend listeners to, we'll put those in the show notes as well.
Okay. Well, thank you for having me. It's always a pleasure, Cynthia.
As we said, if listeners would like more information about the types of nonprofits we've discussed, that is public charity and private foundation definitions, episode 5 of EO Radio Show has the nonprofit basics that describe the distinction between public charities and private foundations. So check that out if you want to explore those rules. Also, there's more information about the many other private foundation rules in our episodes describing the Loot Apple TV series. We've also got episodes covering in more detail the definitions of disqualified persons, conflict of interest policies and procedures, and best practices for approving insider compensation. So be sure to check out the show notes for the links to our prior episodes and other resources. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.